Hi everyone, and welcome to today's webinar, Understanding Whole Farm Insurance for the Specialized, Diversified, and Organic Farm. My name is Rich Myers. I'm the editor here at the National Center for Appropriate Technology, which is more commonly known as NCAT. NCAT is a nationwide nonprofit organization. We have 6 regional headquarters across the country. We work on issues pertaining to sustainable agriculture, sustainable energy, and sustainable communities. And one of the sustainable agriculture programs that NCAT manages, the National Sustainable Agriculture Information Service, which you might know better as ATRA. And today's webinar is being recorded, and it will be on the ATRA webpage later on, usually today, within a couple of days anyway, at www.atra.ncat.org. And today's webinar is being funded in part by the USDA Risk Management Agency, or RMA. And we'd just like to say that we're grateful to the RMA for its funding and support of this webinar. ATRA provides publications, technical assistance through our telephone hotline and website, webinars, and other information to farmers, ranchers, educators, extension agents, and others involved in sustainable agriculture across the country. ATRA is funded itself through a cooperative agreement with the USDA Rural Business Cooperative Service, and we're grateful for their support as well. Our presenter today, Jeff Szysinski, will be talking about whole farm insurance for small and medium-sized diversified farms. Among other options, he'll be talking about a federally subsidized whole farm insurance program, product called Adjusted Gross Revenue Lite, or AGR-Lite for short, as well as the AGR-Lite Wizard, which is the software tool that Jeff helped to develop as part of a 4-year project that was also funded by the RMA. The examples that Jeff will be using today will be focused on the Southeast, although as you'll see, the information he'll be discussing would apply anywhere. And as you're listening to today's webinar, you'll see there on the screen that you can type in any questions you might have. I'm going to be monitoring those questions and sort them out and have Jeff answer as many as we have time for at the end of his presentation. But please, as it goes along, don't be shy about asking questions. The chances are we're not going to be able to get to all of them during the webinar today, but we will get back to you via email about your questions in the days to come. In fact, we always welcome your questions to ATRA. You can use our toll-free assistance line at 1-800-346-9140, or you can go to our website, once again at www.atra.ncat.org, and click on the Ask an Ag Expert button to send us a question by email. And don't worry if you didn't get that phone number or the website. They'll be on your screen at the end of the webinar. And we do respond to all the questions we receive, and it's worth noting that it's a service that's offered free of charge. And just one last thing before we begin, I want to let our viewers know that when the webinar ends, they'll see a short survey come up on their screen. And we'd like to ask that you take a few minutes to complete that survey. We appreciate the feedback. It helps us to make these webinars better. And now let me introduce Jeff Szysinski, today's presenter. Jeff is an agricultural economist here at NCAT, whose areas of expertise include organic and sustainable agriculture public policy, marketing and economics, transgenics in agriculture, organic horticulture, energy use in agriculture, cooperative development, sustainable building, intercultural communications, and beekeeping. He's a past executive director of both the Big Hole River Foundation and Western Sustainable Agriculture Working Group, and he currently serves on the Organizational Council of the National Sustainable Agriculture Coalition. Earlier in his career, Jeff worked for Rutgers University, and he started one of the first CSAs in New Jersey. He holds graduate degrees in agricultural economics and political science, and served in the Peace Corps in Belize, Central America. So I think I'll turn things over to Jeff and let him get things started.
Thank you, Rich, and welcome to everyone. Today's webinar is going to be about a kind of unique product called Whole Farm Revenue Insurance. And it has particular applications for specialized farms, diversified farms, and organic farms. I'm going to talk first about crop insurance broadly, very quickly. I'm not going to spend too much time there. Then I'm going to talk about specialty crops in particular, and then I'm going to look at the AGR-Lite Wizard, which is actually a very nice software tool that's available both in a CD version that you can put right onto your computer if it's a PC, if you don't have a Mac version, or you can actually access it through the internet directly, which is the way we will look at it today. And then, of course, we'll end with some questions, and hopefully we can get to most of those. Crop insurance is a very important national benefit for all of agriculture. All federal crop insurance is subsidized by taxpayers. In fact, it's quite a bit of resources go for that subsidization. It's been predicted that in the future that the taxpayer cost or taxpayer contribution to the cost of premiums for farmers could be as high as $9 billion a year through 2022. And the average premium benefit that a producer receives from crop insurance is about 62% of the cost of the premium on average. And in 2012, just to give you a sense of this, there was $7 billion worth of subsidization of the premiums for crop insurance in the United States. Again, it's a public-private relationship. The crop insurance folks actually sell and maintain the program and monitor the actual policies, and the USDA, the Risk Management Agency in particular, basically set the types of products available and underwrite that insurance. So why insure crops and livestock? Actually, not all farmers do, even though despite this important benefit provided by the federal government, not all farms do. There really are basically two kinds of insurance. They often go by the same or very similar names. One is basically what I would call yield insurance. It also is often called multi-peril insurance, meaning multiple perils, as you can see there: fires, insects, disease. But what's happening there is that these multiple perils impact the yield of the crops the producer is producing. And then we also use a term, often you'll see me use it today, called actual production history, or APH. And I'll be using an acronym APH a lot, so just remember that. And the reason I use that's called is because all yield insurance is based on the historic record of the farm, its actual production history. So when they actually go to calculate a premium for yield insurance, they actually use your individual historical data as part of the information to calculate the premium. And again, that's for yield losses. The other kind of insurance, which came much later in the history of crop insurance, is revenue insurance. And revenue is quite simply yield times price. And the advantage of revenue insurance is that you in fact deal with an additional risk other than the things that can cause yield to decline. Of course, we have variation in price, and that variation in price. A farmer begins the year hoping for a certain price, but if it doesn't appear at the end of the crop season, they could be out of resources. Another reason is that it's become very, very important, I think, crop insurance in the last few years. Actually, last year, in 2011, we had enormous floods that created disasters all across the United States. And this year, and actually in 2011, the highest level of indemnities ever paid out, $11 billion in 2011. Versus the well, actually we're up to $7 billion already this year. But this year was particularly acute, as everyone knows. There was an acute drought throughout the country, probably the worst since the Dust Bowl. And this just gives you, I'm going to run through these slides very quickly, and it kind of reminds me of a virus or a contagion going across the United States. This was as of the end of August, or middle of August, 8/15. These are these are called designated drought counties. These are by county, and the Secretary of Agriculture will designate disaster counties, and that also incorporates any adjoining county, which is the ones you see in yellow. But this is just go through August, and then we're going into September, and now we're finally at the end of October, and I think even if I did it for November, unfortunately, I think it would have gotten worse. So there's very few parts of the country that didn't experience some kind of drought, including the island of Hawaii out there, if you notice that. So the other thing is to insure crops, as I said, and it has to do with revenue insurance, is that the prices are volatile. And prices are volatile not only for commodity crops, the corn, soybeans, wheat that we often think of. They're also very volatile for the specialty crops that folks grow. And these are just some examples of the variability in prices for some fairly common specialty crops, or vegetables are not commodity crops. And you can see that over the years there's significant variation in price. And that, of course, is a risk that farmers take. What is insured? And it's interesting to note here too that corn, soybeans, wheat, and cotton pretty much dominate the federal crop insurance program. And you can also see that revenue insurance is by far the preferred form of insurance, and it seems to be increasing over time, that the form in which people buy crop insurance for those 4 crops. And so a lot of the resources, in fact, are going into those 4 crops. I'm going to be mostly considering the other category, which is about 15% of the total liability coverage in the United States that have to deal with specialty crops. So specialty crops are defined as fruits and vegetables, tree nuts, dried fruits, and horticultural and nursery crops, including floriculture, which is flowers. So these are things that there is potential for getting crop insurance on. Specialty crop insurance has also been rising over time. This just gives you kind of a broader breakdown by vegetables, and then you'll notice that the topic I will spend probably the most time on, adjusted gross revenue, or whole farm insurance, which we'll talk about later, is very distinct, is a very, very small part, but I think has great potential for specialty crop growers, particularly those that are more diversified, who don't specialize in a specific crop. But there are limits to specialty crop insurance as they exist today. First of all, as we'll see some maps that I'm going to show you next, if you wanted to buy crop insurance for broccoli, there would be very, very few places that would be available, and they would only be available in the places where broccoli is mostly grown. So if you wanted to grow broccoli in a different state, let's say, you know, in North Carolina or something, and they didn't have broccoli insurance in that particular county, and they're usually county-based, then you can't really use the crop insurance alternative. And it's also mostly limited to actual production history or yield insurance. In other words, specialty crops, unfortunately, for most cases, there's very few exceptions. Cherries, pecans are some of the ones that have changed since recently, that actually do have what they call actual revenue history, or ARH. We aren't going to go there, but there are some individual crop revenue insurance policies, but very limited and in very limited locations, in very few counties in the United States. So for the most part, the specialty crop producer can only access yield insurance and not revenue share, except for what we're going to talk about today, adjusted gross revenue. And there's 2 versions of that, light and regular, which we'll discuss. So just to give you a visual of this, so these are the counties where you can buy insurance for apples in the United States, in the green. And so there are many places, I would bet, even though we see some there in Georgia, northern Georgia, in Alabama, and in Florida. I think it's possible to grow apples in Florida, but it isn't possible to get yield crop insurance for apples in Florida. And so one way to look at this map is to see this is the location of counties where the predominant apple production is produced, and therefore the policies are available there. Tomatoes, this is actually canning tomatoes, not fresh market tomatoes, but these policies are even more limited. So again, Florida, I know Florida does produce a lot of fresh market tomatoes, and they actually have policies for fresh market tomatoes, but you notice for canning tomatoes there are none. And similarly, I'm sure we can grow tomatoes in Alabama, Georgia, South Carolina, But again, we don't have those available for yield insurance for tomatoes in those counties. And just to contrast again with our commodity crops, here's corn. This is field corn, not sweet corn. And you can see there's a lot of counties in the United States where you can buy individual corn insurance. I know it is a vegetable, but it's also treated as a commodity crop. And so you can actually get revenue corn insurance in many, many counties in the United States. But again, the specialty crop are limited. So what are the alternatives? If you live in a county and you can't get yield-based specialty crop insurance, the other alternative is whole farm, which is Adjusted Gross Revenue Lite or Adjusted Gross Revenue. The difference between those two is a little bit implied in their name. The essential difference is that AGR-Lite has a maximum coverage level of about $2 million or less, whereas Adjusted Gross Revenue can cover have a liability coverage up to $6 million. And there's some other differences that are important, but we won't go into them now. The point I wanted to make here is this is whole farm revenue insurance. This is a very different product, and I think this is one of the reasons it's not used as much, because it's conceptually very different. The idea is that the insurance is providing a guarantee of the average historical adjusted gross revenue of the farm. So it basically uses data on the gross revenue farm history, and it insures some percentage, and you can have different levels of coverage. It does. It basically provides some level of coverage to basically, meet that average revenue that the farm as a whole farm produces. There is one other kind of, and it's not really technically even an insurance policy. It's actually provided by another agency of the federal government, the USDA, called the Farm Service Agency, and it's called Non-Insured Crop Disaster Assistance Program, or for short NAP. NAP is really it's a disaster assistance program, but it functions very much like insurance, and it again is for those crops for which there is not insurance. So if you're in a county again that doesn't have specialty crop insurance, yield insurance, or it's not a commodity crop, or it's just not a crop that you can get insurance on, you can actually access NAP, and we'll talk more about that later. And again, you can get individual policies for the specialty crop, but it's again if available. So what are the benefits of these gross revenue whole farm insurance? One, again, it provides you with a revenue insurance for crops in locations where there is no alternative. That's probably its biggest value. If the thing you're growing, then I shouldn't, maybe commodities is used here, but let's say you're growing fresh market sweet corn and you get a premium price for that. So long as you have a history of growing this specialty crop, sweet corn, it will be represented in the historical record of the gross revenue of the farm. Therefore, it will be incorporated into the value of the insurance you buy. And this is why it's so very, very important, I think, for organic agriculture. As you know, organic agriculture, well, maybe you don't know, organic farming often has to pay a surcharge on the premium cost, because organic is considered by ARM largely to be more risky, so you have to pay a surcharge, and usually you can't cover the value of your crops at their organic value, but rather at only their conventional value. But with adjusted gross revenue, this actually provides a solution. So long as your gross revenue history has been based on organic sales, then you have that value of the whole farm's revenue incorporated, the organic value incorporated in that revenue. Therefore, you can cover its organic value. Also, there's differences in prices. Different kinds of apples, for instance, can have different values, and again, as long as you've been growing those values and they're part of your history, they are incorporated, and you get some protection for that extra value, and provides for quality losses. So again, if you it has that. And the other thing is that it also provides for livestock, which is very, very unique. There are some individual livestock policies in certain counties, and there seem to be growing for individual livestock, like beef, for instance. But This would cover, for instance, egg production, poultry production, as long as it's part of, again, the whole farm's revenue. Unfortunately, adjusted gross revenue, which is, again, we're not going to talk about it all today, is this higher level of coverage of gross whole farm revenue is, again, only available in very limited counties in the United States. There's a few counties in the southeast where you can see it is available. And unfortunately, even Adjusted Gross Revenue Lite, which is what I'm going to be concentrating on today, is also not available in every state in the United States yet. It is, however, for the folks that are joining us from the southeast today, you can see that it is in the entire the Valdosta region of the Risk Management Agency, which includes the Alabama, Georgia, South Carolina, and Florida. It is available there, and so that's why we're focusing on that region a little bit today. So the first thing I'm going to talk is compare a little bit what Adjusted Gross Revenue Lite can provide in terms of insurance coverage versus this NAP program that I was talking about earlier, which is one of your only alternatives. And just at a basic level, Adjusted Gross Revenue insures a percentage, and you get to choose this percentage of the historical gross average of the whole farm's gross revenue. And the maximum level of coverage you can get is 72% of that average gross revenue. So it does have, and we'll talk about this a little bit later, it does have what I would call high deductible. In other words, you do not see any benefit from the insurance until after you've had at least 28% loss greater than your average. That's important, and you'll see that more clearly later. Non-insured, however, has other limitations. Again, it's for a crop that's not insured, not available insurance any other way, and it's kind of catastrophic related, so it's a yield-only insurance, and it only covers. First, you have to have a coverage is 55% of yield after a 50% loss. So you first have to have a 50% loss on that crop, and then it only provides 55% of its value in terms of coverage. So we're going to look at two cases today. I'm going to go one in depth, this one, case one, the Florida Diverse Organic Farm, and this is based in Alachua County, Florida. A very important place for me. I spent many years in graduate school in Gainesville, Florida, and this is actually in Alachua County where Gainesville is located. So for all you Gator fans, we'll see what farming, diverse organic farms are like in Florida a little bit. And this is a case, of course, that was contrived. It's not a real farm, although it could be. And we're going to look at a loss scenario. We're going to basically calculate a premium for this case, what it would cost this farmer, this hypothetical farmer, to buy the insurance, and then we're going to look at a loss scenario that if they had a significant loss, you can see 50% in their honey, 50% in their egg price, some are price, some are yield-related losses, and we're going to see what the likely indemnity payment or the payment for loss, that's what indemnity means, will be for the farm. Another one we'll look at a little bit less carefully is Georgia Specialty Crop Farm. And this is a farm, again, a hypothetical farm that's pretty much focused, obviously, on fruit, blueberries, apples, and peaches, and we'll look at a loss scenario that's 50%. In this case, we're going to actually compare what AGR-Lite would provide in terms of coverage and indemnity for that loss, and what it would be contrasted to if, in fact, you bought individual policies, individual yield policies for blueberries, apples, and peaches. Again, you can't buy revenue insurance for those three in Georgia. So this is what our website, and I'm going to now escape out here and go to the online version or the internet version of the tool that we created. It's a very neat tool. Now I'm coming into this tool as if I had already signed up and become a person. I'll just show you briefly going to the home here page. If you would come in for the first time, you would come into this page, and everything. This is a very, very nice, very well user-friendly program. It took a number of years to create. This program was designed by farmers. from the inception. They helped us design it. They tested it. We had several versions of this product. They tested it all the way through. I'm very proud to say that this is one of the most user-friendly tools available on the web for agriculture, and I think it really is a tribute to the farmers that helped us through this. And again, you can have a CD version if you don't have high-speed internet and you want to put, or you just want to have it on your own PC. You can write us and or send us an email, and we'll send you a CD version of it so that you can load on. Unfortunately, it's only for PCs. It's not a Mac available. But this just gives you the basic idea what you will need. Now, it's important to see here that Schedule F is really important. That is the basis upon which the premium is calculated. So I'm wondering if I can go backwards or if I need to go. I'm going to go. Do you think I have to? I probably have to log in again because I moved. So basically, after you get a password and create an account, this is what you would do. Oops. I must have spelled. My name is very long, and even I sometimes cannot type it correctly. Okay, there we are. So after you go, what you would do when you normally would come in, you would go through an eligibility checklist. It's just a way to make it, there's some eligibility requirements. I'm not going to go over them now, but they're pretty limited, but mostly you have to be in that state where it's offered. So it basically checks your eligibility requirements, make sure you're not trying to insure more than $2 million, those kinds of things. And then you come to this page, and this is where you would start to basically go. And I'm going to load the Florida Organic Diverse Farm here, which has already been pre-done, so we didn't have to spend a lot of time putting all the data in. So I'm going to load this profile, and we'll take a look. So you can see this has a very, I don't know if everyone has used TurboTax, it's very much designed in a look to TurboTax. And I'm going to go start. So normally you would start here. The first thing you need to do to calculate a premium is to put in the tax history. Again, the premium is calculated on the historic gross revenue of your particular farm, which is one of the downfalls of it. For buying this insurance in 2013, you have to have been farming at least since 2007. So that's sometimes, we've had a lot of beginning farmers who would love to use this product, but they don't have that many years of insurance. From an RMA point of view, having some historical data, of course, is important to understanding the risk and therefore the premium that would be entailed for providing insurance for a farm, and without a historical experience, it's kind of hard to do that. And remember, this is true of yield insurance as well. Yield also was based on the historical farm of the historical record of the farm for the individual crops. But anyway, we go through and enter in data, and I'll show you the first one here on 2001. I've already completed these, but basically you get your tax forms together, your Schedule Fs. If you don't have Schedule Fs, if you're incorporated in different ways, it's probably better to work through an accountant, or get an accountant, because you need to basically put the equivalent values in these boxes that would be the equivalent of a Schedule F. And we did it only with Schedule S because that's about the predominant way folks actually report their revenue in terms of taxes. So, and the one that's mostly important here is the line 4 of your Schedule F, which is the sale of livestock produce and gains, which is really the measure of your gross revenue. The adjusted is important to point out here because, as you noted, it's called Adjusted Gross Revenue, not just Gross Revenue Lite. And the adjustment is a bit of an issue, but basically it comes down to this. And then the easiest example is apples and applesauce. If your farm is growing apples, this insurance will cover the production, the yield and revenue relationship, risks associated with the production of the apples. It will, however, not deal with your applesauce. Let's say the farm takes the apples and makes applesauce and sells the applesauce. Well, the applesauce is really an applesauce business, at least in terms of risk management agency, and therefore you should get business insurance for your applesauce, production. And so what you have to do is you have to, in terms of your taxes, any revenue that was attributable to the applesauce part of your business has to be subtracted back out. And so you essentially think of it as the value of the apples as they cross the field. That is the value of what you're going to base your premium on. That's the value that is going to be insurance. This is crop insurance, not business insurance. So what you do is you go and enter all these data, and really I could explain some of the other ones, but it's really it's really very simple to just follow the directions and go through this. So we go through all the years, and we do, I've done them all already, at least the essential gross revenue here. And unfortunately in 2011 they changed the Schedule F, so we had to adjust some of the things, and we have a warning there because it's the first time, I think, in 20 years they changed the Schedule F form, but they did it while we were doing this project, so we had to adjust ourselves. And then you get to this final screen, which gives you a nice little graphic. I like this tool just even for kind of business planning purposes. You can see your gross revenue history there of this farm. You can see its average, and this average is what essentially is what we're going to base the premium on, and this is how we're going to effectively have coverage for the thing. And you can even get larger graphs of these graphs. But you can see this farm has experienced considerable variability in their gross revenue, which is not untypical of most farms. Then we're going to get ready to start to look at the production year. And so this is 2013 for this farm. This is what the farmer expects to produce in terms of gross revenue in 2013. And we went through all of the different commodities here. And I've already put these in. These are the same as you recall from the earlier slide. We have the collard greens, the blueberries, carrots. This is that farm with the $33,000 in gross revenue in the insurance year. And it's pretty straightforward stuff. And this is very specific to Alachua County. So when I want to add, let's say I wanted to add another commodity to grow, or another product to grow, I have a list here. And these are the lists that are specific to Alachua County, Florida. And these will vary by county depending where you are in the United States. So they're not going to be the same for every county in Florida necessarily, or every county in Georgia. And you can see there's quite a bit of different things that can be grown that they have some history of, but there are also some that aren't, in which case you can use other crop if it's a crop, or other live animal if it's another animal that you grow. So there's alternatives, but you just pick the one that's best. And I did that, for example, we can look at here, collard greens. So I'm basically putting in yield information, and it's coming up with a value. All right, so I'm not going to mess with those because those are already done, and it's a little bit hard to do. So let's go to the coverage. So this is what the farm, he wants to, we've got this value here. Now it kind of summarizes again the average, and then it does one of two things. It takes basically it will ensure the estimated adjusted gross revenue for this farm is $33,550, and the indexed average is $38,000, and that indexed average is really some people have complained if you just take the straight average, then what if a farm is improving like this farm seems to be doing? This kind of fudges it up a little bit and gives you some benefit of the advantage of growing. In this case, however, it's basically the estimated AGR of this farm is going to be that's what's going to calculate is $33,550. Now, interestingly, and I actually found more about this in just fairly recently, and I always knew this, that you can mix and match Adjusted Gross Revenue Lite with other crop insurance policies. So, for instance, if you had blueberry insurance in Alachua County, Florida, you could buy individual yield insurance for the blueberries, and then you could buy AGR-Lite for the rest of the farm. And it would actually lower your overall AGR-Lite premium, although you would have to pay the premium for the blueberries, so you'd have to total them together and find out if it's worth it. But I know a farm here in Montana, for instance, who basically bought catastrophic insurance for all of his crops and then basically bought AGR-Lite on top of it, and it actually worked out quite well in terms of lowering the AGR-Lite premium cost. So you can play with the idea of mixing and matching, but we won't here. And this is a calculation, a very important point. It's called a loss inception point. I'm not going to read it. You can read it when you look at the tool yourself. But eventually you come down to, you have different levels of coverages, just like you do for insuring a car. And they're really different kinds of levels of deductibles. So you have this range of different things you can choose. Now I'm going to choose the highest rate. And remember I said you can have effective coverage of 72%, and this kind of explains where that comes from. Because basically what this says is I'm going to cover 80% of that adjusted gross revenue. That's what I'm going to get coverage for. But if I actually have a loss, it's only going to pay me 90% of the loss. So if you multiply 80 times 90, that's how you get your 72%, and that would be 72% of the average gross revenue would be paid if you had a total wipeout, if you had zero revenue for that year. That's what you would get paid. And this loss inception point is the point at which the deductible kicks in. Remember, so you have 28% of loss from that gross revenue. So in other words, if you buy this high level until you reach the point of $26,840, until you had that loss from your expected $33,000 or $38,000, you're coming down, then you don't start to see payment until you've gone past the loss inception point. We'll come back and see a graph of that later, which will make it much more clear. And again, this is now it's calculating your premium. And this premium, if the data is really good and authentic, and it has all of this has to be verified by your crop insurance agent, this is the actual premium it would cost you to buy insurance at that coverage level in Alachua County, Florida. So it does give you the premium cost. There's also a little administrative fee there. So it's $1,000 to buy this insurance for that farm in Florida. And now we play, which I think is the most interesting part of the tool, is to play the game of what if. So what if my collard green crop crashes entirely and I get zero revenue? You know, would that kick in enough? Would that be enough loss? Would I have enough of it, you know, to get over my deductible? Think of it like a car. You know, if you break your window and you have a high deductible, you don't see anything from your insurance. Well, with AGR-Lite, it's somewhat the same, and it's a rather high deductible. You might even wipe out your entire collard green crop and still not be able to get insurance because the whole revenue farm hasn't actually crossed that loss inception point. So I put it, you can create it in many different scenarios. It's kind of fun, but I actually put one in here again to save some time. I call it big loss. It's that loss that I said we were going to look at on the presentation before, and I'm going to load it, and it's already, so I've saved it, and you can save as many of these versions as you want, and it's going to bring it up now. And so what this was is, as I was pointing out, we said we had a 50% loss on it. I think this was on yield. Let's see, yes. So basically, I'm going a what if. So I expect to have a 50% loss. However, I didn't have any loss in price. My price I thought was going to be $45, and this is for, I believe, a box of tomatoes. I think it's a 25-pound box. I don't remember. Anyway, I'm going to have that 50% loss on yield, and so I'm going to have a $4,500 loss on my tomatoes. And so I did the same for all the others, the scenario I did, and you can see we have bees and eggs in there. Let's just look at that really quickly just to show you. So we have eggs, we have organic eggs. This is an organic farm, but what happened here was the price crashed. I guess just too many organic egg producers in Alachua County that year. So I lost on the eggs. So again, I put all the losses in, and then it calculates this really cool information for me. It basically says, this is my estimated gross revenue upon which the premium is based. My actual income was $13,000. This is the amount I was below. This is my loss inception point, and this is my loss payment in my that I will actually get, and that's actually the 90% of the 80% of that. And let's look at the graph, because it really is, I think, the pièce de résistance of the tool. You get this very nice graph that kind of explains everything. So here's the farm. The farm's revenue, gross revenue, was going up and down. They had expectation of being here, but unfortunately ended up here. So here's our average over the time. Here's the loss inception point. So the farm first of all has to lose that amount of money before they see anything, and in this case they did, and they went all the way down here, but the insurance is only paying that value from there to there for that loss. So this loss is suffered by the producer, by the farmer, and this is the one that's made up by the insurance. And you can have another, and then another nice thing about this is at the end of that you can actually print out reports. These reports, for instance, this report is a report that would be needed by the crop insurance agent, and it's actually already in the format that would be necessary for the crop insurance agent to fill out your form. Now again, everything has to be verified by the crop insurance. This is just an estimation tool. Don't go sue the RMA or your insurance because this has to be checked by your crop insurance agent. But this really will help them. One of the criticisms we had of why often it is not used is it's complicated and there's a lot of information. So with this tool, we've made it much easier for the average crop insurance agent to actually actually calculate the premium and write up a policy for you. So that's basically how it works. And again, you can try this with as many different kinds of farms as you want. Now I'm going to go back, hopefully, to my presentation. I'm going to advance here. So I did it, and so remember we just covered this case of the farm in Alachua County, and I wanted to give you a comparison of that. If you had bought insurance, the NAP insurance for the same farm, what would be the difference in terms of cost and benefit? And as you look at this, it's interesting to note that, remember I said that you can't get anything from NAP until you've had at least a 50% loss. Well, there was only one crop that had more than a 50% loss in our case, and that was onions. So the only thing that NAP would have paid for the same level of loss would have been on only the onions, and that's the onion value. And yes, it's true that the cost of the premium was a little bit cheaper for NAP. It really only nets you $213, whereas the same farm buying the AGR-Lite in the same county would have cost a little bit more, but a far greater benefit in terms of the losses given those losses. So my bottom line here is, and probably in most cases, I would argue that if AGR-Lite is available and you don't have any alternative and you're a fairly diversified farm, AGR-Lite is a serious alternative form of insurance. But remember, again, it is a fairly high level of deduction, and many farmers would like to see the level of coverage raised so that, in fact, it would be more comparable to what is available for instance, corn revenue insurance. Now, the other case that I'm not going to go into today was the fruit grower in Georgia. Now, I ran the AGR-Lite scenario very much like this, like I did for the other one, and I set up a loss where we had a 50% revenue loss on all of the 3 crops. And again, here's a little more interesting case. And then I compared that if I were to buy actual individual yield loss insurance for each of those in that county in Georgia, what would it cost? And then again, what are the relative costs and benefits of these 2 insurance? Now, I used a price election of 70%, which makes it very comparable to the 72%. What's interesting here is that you can actually get a higher level of coverage with individual insurance than 70%. You can go up to 85%. So that might still make the individual policies more beneficial because you could get at a higher cost, you could get a higher level of coverage. In fact, we have recommended to RMA that they move up the level of coverage so that the effective coverage is more like 85%, and I think it would be very comparable. Then it would actually, AGR-Lite would be probably lower cost and provide as good or better insurance coverage. But even in this case, you can see that they're pretty close. And it's interesting to note that you have to put out a lot more money in premiums for the individual policies than you would for an AGR-Lite policy, and the net payment basically for this given loss would be about the same, a little bit actually a little bit more beneficial for the AGR-Lite in this case. But this is a very specific case, and this is a very unique case. I mean, are you going to have a 50% loss of all three crops simultaneously? Maybe, maybe not. It's probably might be more likely that you might have 100% loss, let's say, in the blueberries, and a lot less loss in the apples and peaches. Maybe no loss. In which case, AGR-Lite might not be the better alternative, because those two crops may in fact keep the revenue of the farm, the whole farm's revenue, high, even though the one crop was lowered. So it's a little bit of a game here back and forth, but it's something worth exploring, and this tool will provide you, and working with your crop insurance agent will provide a really good way to explore the alternative of AGR-Lite. So in summary, whole farm revenue policies can work well for diversified specialty, particularly organic farms, I would argue, again, because it incorporates that organic value, and it's particularly true if there's just simply no other option available. If you are only growing a single crop, or maybe only two crops, it's probably more beneficial to buy specific crop policies, again, if they're available. And of course, usually they're only available in specialty crops for yield insurance. So you don't get that benefit of revenue insurance, that AGR-Lite. So it's always kind of worth exploring. And then the level of coverage of AGR-Lite is relatively low, with a rather high deductible. In other words, you have to experience pretty substantial loss for the whole farm before the insurance kicks in and you get paid. So with that, I think we'll turn to some questions, and I hope we have some. So Rich, do we have some questions?
Yeah, we sure do, Jeff. The first one, at what time or what point does AGR-Lite make payments? Is it the time of harvest or the time of the claim? It's
a time of the claim. This is actually a little bit of a criticism of AGR-Lite, because when do you file your tax forms? Well, some people, you can file your tax form on January 1st, I believe, but you have to by April 15th. The claim cannot be made until you actually file your Schedule F for that year. So if you're early and you file your Schedule F early, you can start getting the adjustment process going. But even that adjustment, there's going to be an insurance adjuster who's going to look at everything and then basically do that, and that can take some time. However, I just want to point out, for yield and revenue insurance, they often take time too, because there's always the insurance adjuster period that has to go on, and the claim has to be made, and the paperwork has to be filed. So there is a bit of a lag, and that is a drag, particularly if you had a significant loss. This is kind of a pervasive issue throughout all crop insurance, is the lag between the loss and the ultimate payment. And I know RMA and others are working to try to shorten that period as much as possible, but it is a process.
Okay, the next question is, what insurance options are available for new farmers who don't have such an extensive historical record?
I wish there were more. Unfortunately, it's difficult. Now, for yield or revenue insurance for a specific crop, remember I said there's commodity crops that have both yield and revenue insurance. It works a little bit differently. So let's say you were just growing field corn and you were a beginning farmer. The way they deal with beginning farmers there, because they also don't have a yield history, for instance, what they do is use what's called the county T average yield, and they insure at the average yield in the county in which the beginning farmer is farming. So they can get over that issue of using data for those years that the farmer hasn't been and they usually use they use a lot of different averages, 10 years, and then they use this Olympic average. It gets confusing, but basically it is all based on historical data. But they just use these county proxies as a proxy for the years in which you didn't farm. So for those commodity crops and for those specific individual yield crops, there is a way to do it. Unfortunately, because AGR-Lite is a whole farm insurance, there really is no, what farm would you compare to? A beginning, let's say you have a beginning diversified farm very much like the one in Alachua County, and you had that farm, it was your first year, how would you come up with a proxy value, for the historical average of that farm? And let's be fair, a beginning farmer in the first year is probably a higher risk than a farmer that's been farming 5 years. And we made a recommendation based on the research in this project, to perhaps shorten the number of data needed, let's say 3 years. But I think there is some legitimacy to the idea that you should have some historical record from which to know how risky or not risky you are in terms of insurance. So we're working on that, and we're having some ideas, and maybe in the future something will be work, because I know it's really a big issue. It would really be nice to have beginning farmers have some crop insurance available, particularly for these diverse farms, but really hasn't been available yet.
Okay, kind of a related question. Is AGR-Lite something that insurance agents are familiar with in your experience, and do you have any tips about how possibly to find an agent who could help you?
I should have pointed out on the tool itself, there is a list. You can just, it's one of the help. I didn't even really go into the help. You should explore the help system. The help system is extremely extensive in our tool, and at the very end of the thing there's actually a button you push, and it lists all the available crop insurance agents in every state where it's available. By law, and by the fact that we have this kind of public-private relationship in crop insurance, any of those 38 states where AGR-Lite is available, and in the Southeast, that's all of the states, all crop insurance agents, so you can just find any crop insurance agents, have to make AGR-Lite available to you. Now, I'll tell you, from our experience, it's not necessarily a policy that most crop insurance agents are familiar with. And they may even try to push you away from it because partly it's because it takes more time to fill out the paperwork and they don't know it. And when people don't know something or it takes more time, time is money, they'd rather sell you something that's a little easier and what they understand. So it does, sometimes you have to educate your crop insurance agents a bit. And once you have this tool, that would be a lot easier to do. Plus, if I noted, we have these great forms that you get to print out at the end. Taking those forms with you will make it much, much easier for that crop insurance agent to begin the process of writing up a policy. Again, they have to verify everything, so it's still a little bit more work. But again, they're your crop insurance. You're hiring them. They are the folks that need to serve you. So I'd say it's a little bit of a mutual education that needs to go on to see this kind of product being used more.
Okay, the next question, if I change from selling my milk as a commodity to selling directly to consumers in this calendar year, do I still need to wait 5 years to establish a history?
Yes, you would need to wait 5 years. And it probably, if the only thing you're going to produce is milk, one crop, I mean, you have to be careful here with language. Commodity crops are often referred to as things like the big ones like the corn, soybeans, and the wheat. But they're also, in RMA language, it's any crop is a commodity crop, and it gets confusing because specialty crops are like vegetables and other things that are not commodity crops, but yet, field corn is technically a vegetable. So it's a little bit confusing there, the language. But the point here being that if you're only growing one thing like milk, you could buy AGR-Lite for it. One thing I didn't tell you is that until you have at least 3 separate enterprises, so let's say you're doing milk, corn, and soybeans, and you're selling those all, that's 3 commodities or 3 enterprises. Then you can get the highest level of coverage with AGR-Lite. If you only were producing milk, and that was the only thing you were selling, that was the only thing that was showing up on your gross revenue, you could buy technically you could buy AGR-Lite if you had 5, and really this idea that as a commodity, it's just what was, if you were growing milk for the last 5 years, it was the only thing you were selling, and it was the only thing creating a gross revenue, you could buy AGR-Lite this year. You would get very low coverage, and you could do it, but I would use the tool and try to find out if it's worth it, because the level of coverage would be quite low, and you'd have to look at the premium price. So I'm not sure it's an advantage for a producer who's only growing one thing, producing one thing.
Right. What happens if you expand or subtract from the amount of acreage that you're farming from one year to the next? Does that enter into how you calculate your historic revenue?
It does not, unfortunately. It's what's that number is your gross revenue. So if you expand or shrink the farm, of course, expanding and shrinking a farm by acreage alone does not necessarily change your gross revenue. I mean, there are some very small farms that have very high gross revenue. Depends on the mix of crops and their value. But yes, technically speaking, it's really transparent to the acreage. It's covering the gross revenue. And if you change fundamentally the way you're farming or the acreage you're farming, it still is going to be basing that revenue on the historic revenue, and regardless of the acreage.
Another sort of related question, if a farmer who does have a 5-year history leases a new farm, could revenue from that new farm be eligible for AGR-Lite?
Yes, I believe so. I'm going to say yes and write us an email, and I'll check that out. I'm pretty sure that if you have control over the farm, fundamentally, you can take insurance out of it. So if you add a lease to your existing owned farm, you can still insure it. Surely, again, this will make your revenue higher, but again, it's not based on acreage, it's based on revenue.
Okay, well, I believe that that's going to have to be the last question for today. And I would like to remind folks that the webinar will be posted in the next few days, possibly even today, on the ATRA website at www.atra.ncat.org, which you see there on your screen. And I'd also like once again to thank the RMA for their part in making this webinar possible today. And I want to remind you that if we didn't get to your question today, we will get back to you about any of the questions that you had in the coming days via email. And if you have other questions that occur to you, either about the webinar or other issues, please call our ATRA hotline there, which is on your screen, or go to the www.atra.ncat.org page and click on the Ask an Ag Expert function there, and you can send in a question that way. And while you're on that website, you might want to check out our other webinars. We have quite a number of them there, and a lot of sustainable agriculture related publications and some other services there you might want to check out. And before we leave, I'd also like to remind everybody out there, our viewers, that once the webinar ends, on your screen you'll see a survey, and we'd really appreciate it if you would take a few minutes to fill that survey out so we can keep improving these webinars. And that's all I have for today. Thanks, Jeff, and thanks everybody for attending today.